Hello and welcome back to SEC Roundup. I'm Nick Morgan, the founder and chair of ICAN, Investor Choice Advocates Network, and host of today's SEC Roundup. I am very pleased to be joined by Suzan Rose. Suzan, how are you?
Very well. Thanks for having me.
Good. Well, you are a repeat guest, so thanks for being on again. Last
Absolutely.
time we talked about the SEC comment letter process, and some other time I'll give you an opportunity to amend your comments on that process. Given what we're going to talk
Perhaps.
about today,
Mhm.
of course, you are with AMA, and the issue we're going to talk about is near and dear to AMA's heart. That is the recently finalized SEC rules regarding securities dealers. This is an issue I think not enough people are paying attention to, so I really appreciate you coming on and sharing your insights about the new rule. Let me set the stage a little bit. So this issue of who are securities dealers has been the subject of ongoing litigation for some number of years. Forbes ran an article, I think you were quoted in the article last year. The government is quietly suing its way to broader powers over traders. So this was and is sort of classic SEC regulation by enforcement. We'll establish things through litigation. So in the face of that, one might have been mistaken to be optimistic about having a rule where we can at least look at a rule and have some certainty. I think you're about to tell us we should probably not take comfort from the fact that we now have a rule, but I'll let you talk about that. So maybe start by just giving us a quick overview, just at a high level. People can read the rule. I'll put the rule in a link in the comments to this, but what does the rule do at a very high level?
Sure. Well, look, the rule at a very high level expands the application of broker-dealer registration to those who had not been traditionally considered to be broker-dealers under the Exchange Act. So it's a significant change from over 90 years of common practice. Broker-dealer registration is not something to be taken lightly, and who it would apply to, you'll see if you read the rule more carefully, it actually can apply quite broadly. There are aspects of the rule that give you some definitive guidance, but then there is an open-ended area of it that I'll get to. But suffice to say, it could significantly change your business, particularly if broker-dealer rules are not well suited to your business model, say for a fund manager or a private fund.
So that's interesting. So there may be people out there, advisors out there who don't consider themselves dealers, wouldn't have thought of themselves as dealers under prior standards, who may now be captured within this rule. Let's talk a little bit about that open-ended provision, because I know there was kind of a sigh of relief in some quarters, like, we finally have a rule, we've got some certainty, now we know, what the SEC is going to do or not do. But what is that open-ended provision that you're referring to?
Well, look, I think I just want to back up for a second and just say that I don't think that this rule has yet gotten the thorough consideration that it deserves. There's a lot in there, and the headline reactions were largely positive because two of the more troubling standards were dropped from the final rule, as well as an aggregation requirement. But if you read the whole rule and carefully consider it, and in this case, also consider the enforcement activity on dealer that you were referring to and has been occurring for several years in district and circuit courts around the country. The rule in these out of spotlight cases finally merged lanes. And what we now have is a rule that has the potential to ensnare private fund managers within and outside of the determining standards that the rule sets forth. So in terms of what the rule does, as for the rule, sure, the quantitative standard and the first qualitative standard were dropped, and they were definitely critical concerns. Also dropped was the requirement to aggregate multiple manager accounts despite independent trading decisions. But now there's the ability to stretch the slightly modified second qualitative standard of the rule to cover most any buy and sell activity by a multi-PM firm. So you can have the same effect as the originally proposed aggregation. So not exactly a win. The remaining two qualitative standards leave you with more questions than answers when you actually read through them. They're a bit open-ended. There are certain things that are just not clearly defined. But worst of all is what you were referring to, the fact that the rule explicitly includes no presumption that the determining standards must be satisfied in order to be deemed in order to deem a manager or its funds a dealer.
And we know provisions like that from how the SEC treats other rules are sort of a very large door for the SEC to apply its own discretion in applying this rule to specific managers, which I think is probably the problem that you're highlighting. Is we're back where we were when we were facing regulation by litigation, which is the SEC has a lot of discretion in how to apply this rule to a particular manager.
Sure, the commission has granted itself extraordinary discretion in making the determination, much like it has in those court cases where it's been reinterpreting longstanding securities laws in those court cases to define a dealer as anyone who buys and sells securities as part of a regular business. Seriously, like who doesn't meet that definition?
Right.
And it's won some of those cases thus far. So don't expect logic and reason to prevail in determining whether you can be deemed a dealer under the rule or otherwise.
Your mention of the litigation reminds me of a comment someone made about that litigation, which is this appears to be the SEC looking for a problem that doesn't exist. There's not a groundswell of interest that I'm aware of in any quarter, but yet the rule may have unintended adverse consequences on investors. And what do you think are some of those unintended adverse consequences?
Well, it's interesting that you use the term intent in describing this rule. The negative consequences are a result of conscious design. It's hard to describe them as unintended when they were raised by a wealth of commenters, and many of them were considered or acknowledged in the proposal or the final rule. Look, as far as the rule is concerned, obviously you can see the harm that it would pose for fund managers or private funds. Having to register as a BD is a huge change. What happens if you're found to be a dealer? For fund managers or funds, good luck fitting that square peg into the round hole. The requirements weren't designed for them. The net capital requirements aren't consistent with how a private fund works, and you can forget about participating in IPOs. And interestingly, that was something that the commission had a short sort of soliloquy about in the final rule. It was vacillating between, the potential harm to the IPO market and the potential tough choices for fund managers to have to decide to either abandon IPOs or their presumed dealer activity. They claim that a very small number of fund managers or funds would be subject to registration. But meanwhile, there was no grave danger or imminent harm or serial abuse they've identified. So why the massive change? It knows that the fund managers or funds required to register as dealers would incur what likely are unbearable expenses and changes that could be business ending. Those required to register under the rule standards couldn't possibly get it done in time to meet the 2025 deadline. So if they fit the standards right now, they'd have to start the registration process, which is slow and lengthy. The SEC knows this. So really what this rule does is act as a deterrent for fund managers. It forces them to constantly second guess or limit investment decisions out of fear that the SEC could just tap them on the shoulder at some point, never truly knowing if or when they must register as a dealer, since it's not intuitive. And what they face as well is punishment for the time that they hadn't already been registered. Because remember, in the enforcement cases, there was disgorgement of profits for the period in which you had been an unregistered dealer. So it does claw back.
Interesting. Well, so I'll stop calling them unintended negative consequences.
Let's call it conscious design.
Right. So you just described negative consequences that would impact investors at the fund level. But let's go, ICAN, we're interested in maximizing investor choice. Let's talk about possible negative consequences for investors in the funds. So like the limited partners, for example.
Sure. Well, look, for investors versus fund managers, the impact's going to vary on whether they're invested in private funds that currently are in scope or not. Private funds certainly will be wary of triggering dealer registration now, and absent clear boundaries of what is or isn't violative conduct due to no presumption. I could easily see it dampening trading activity and hence liquidity out of an abundance of caution. And I believe Commissioner Peirce made reference to this in her comments. For fund managers who would be in scope for dealer registration at present, those managers and or their funds have to choose between curtailing the activity that meets the defined standards right now or registering as a dealer. Should the latter happen, the investor would have to consider significant changes that registration would bring. Everything from limiting access to IPOs as an investor to tax consequences, they're very real concerns, as would be redemption terms given the net capital requirements that BD registration puts on you. If they wanted to be an investor in a broker-dealer, they'd have chosen that versus a private fund. Whether they stay or they go is a very real question, particularly when there are so many other private funds out there to choose from that won't have these issues or will take care to avoid that they don't.
Well, you've raised a bunch of issues that didn't even occur to me, so I really appreciate you coming on and describing those things. We'll have to see how it shakes out. A lot to be done here. And if nothing else, hopefully more people will pay attention to this significant change that I think has really flown under the radar. So, Suzan, thank you for joining us, and everyone else, will see you on the next SEC Roundup. Goodbye.
Thank you.